Good afternoon. This is your host. Quickly, we are going to look into how to trade with a Fibonacci level, a specific levels of Fibonacci. Yeah. Uh, if you are still new to Fibonacci levels trading, please get get a material on introduction to Fibonacci ratios and numbers. How how does this how does this language or structure evolved? Yeah, you can get them on the internet or whatever. But this is for the advanced class. Yeah, I've done a video in the past for the VIPs on people how to trade on how Fibonacci numbers came up, then the brain behind the Fibonacci levels, then those ratios, the calculations of numbers to that gives those ratios. Yeah, I've done that in the past. Please refer back to the video. Yeah, this is just how to trade with a specific levels of Fibonacci. We just rely our attention to a certain specific ratio levels that are critically traded, and that gives a high probability trade. Yeah, whether you like it or not, when price reach those levels of resistance and support, they are going to be a reaction. It'll be a reaction. Yeah. So you say that what is the use of why Fibonacci? Why this Fibonacci? One, the significance of it, the usual use of Fibonacci evolves around the price action, the price movement, how price behaves at a particular level of support and resistance. Yeah, so you can use Fibonacci will help you to project in mind ahead of the market reaction with particular levels. When you put up your Fibonacci levels at which the market will react, level at which the market will retrace and expand to at what level. So it helps you to quantize your prediction of price movements. You say it helps you to critically have in mind at what level of support, because not when price is moving up and down, it's gonna behave in a particular level where the market makers or the institutional traders are taking position and they are watching over. Yeah, resistance. It helps you to critically have in mind at what level of the price will at what level the price would possibly react. Yeah. Yeah, I told you the market makers makes the price. Yeah, they make the price. So they watch over certain psychological or levels of markets. They watch over those levels to trade their position to decide whether to exit or to buy. Yeah, they watch over Elliott waves. They make use of Elliott waves. They make use of Fibonacci. Some PowerPoints or thereabouts. Then maybe whole numbers. Yeah, so they make use of those levels to determine their physics. So we are going to specifically base our projection on Fibonacci first. Yeah. So now, second, the second point of this thing where you're going to use your Fibonacci is to help you to, you know, to project your entry and exit point. A specific entry that when this price reaches, when price hits these levels, you know that this market is highly predictive. Then at what level it will expand to, at what level it expands to. Yeah. It also helps you to project in mind your entry point, so that when you are, even if you are not, you are going to be around, when you get the Fibonacci levels intact, you ever fix your market to enter at pending order. That means when price get to this level, please enter for me. Yeah. So when you get to this level, when it expands to this level, exit. So it helps you to project that. You help you to fix that point. Yeah. Help you to project in mind your entry point and exit level of price, of market price. Yeah. So these are the two important significant use why we prefer to use Fibonacci levels. Now let's go back to the. Now there are three levels of Fibonacci we are going to base our listing upon, our analysis upon, or our projection upon. There are three levels. We have the high probability zones, the critical price zones, and equilibrium level. High probability zones, three levels of Fibonacci zones. Of Fibonacci, let me see, Fibonacci price rejection, or let me say price ejection. Of price rejection. One, we have the high probability. We have the high probability area, zone HPZ. Then we have the critical price zone. So we may abbreviate it as PZ. Then three, we have the equilibrium. That's area of equality between demand and supply, between buy and sell. Equilibrium. Yeah. Equilibrium level. Yeah. So price react within these three zones. So anytime price falls into any of these zones, you can fix your entry point at these zones, either by using pending order or market execution, instant execution order. Yeah. So under the high probability zone, we have this ratio, usually moved by price. We have this ratio of 78. Then we have 89. Yeah. 89. Then under this thing we have 62.0. Then under the equilibrium, which is the 50, the midpoint, 50. So 50, yeah. So I tell you, 89 and 70 are the price high probability zones we have. When price falls into this, when we get to chart, you see that when price fall into this area in its a retracement, you are going to get a highly predictive expansion. So the target will be much than the rest. So if it falls into 62.0, it will move to, it will move. Then 50, it will move. But according to our trading experience, how we have been trading this, when price retraces to 89 and 78 and it withdraws back, it's going to descend down so much. So the probability, the ratio of your success, or the ratio of your risk reward in your money management is very high. It's very high. So you can target one ratio this as even as your this thing, as your take profit first take profit, you can still target, and you are sure that the price will hit this target. Yeah, you are sure that price will hit it, guys, because price has touched that area of that zone of 78 or 89. Yeah, so if it's gonna be 62, it's gonna be 62.0. So you can target your first take profit could be around. I'm talking of experienced trader, please. Talking of experienced trader. If you're not an experienced trader, your target, please leave your targets first take profit at 5. So your target could be 10 RR. That's really reward ratio. But it's going to be 50. It is 50.0. Means your target, your first take profit target could be around 1/3 RR. Yeah. So these are the experience we have in the market trading these zones. Yeah, so that is the experience we have trading this zone. Yeah. In our next video, we're going to show you the trade examples, how we navigate through those using using these zones. Yeah. So this is your. So now, in a falling market, this is how price reacts. This is what you get. It is how price, the setup, the pattern you have. The market is coming down. This is impulse, bearish impulse. Market moves from here to downward to 1. First point. Point 1 is an impulse. Then it's now, market now moves upward. It retraces upward. It retraces against this impulse. It as a counter movement against this impulse to 2, which is your point of retracement. So price is going to watch over as price is contracting upward. And I told you that Fibonacci is all about impulse and contraction. So impulse is the actual trend. While contraction is a counter trend. So contraction is a counter trend. Impulse is the actual trend, the original trend. So contraction is just a counter trend. That means a correction of a trend, of a main trend. Now expansion is where the target, your expansion of impulse after contraction. So point 1 is impulse, point 2 is contraction, then we have point 3 as expansion. So that means price hits this level, then it's going to retrace upward. You know, just like, you know, price market moves in a wave structure. In a wave structure like this. See here, wave downward. In a wave structure, it moves zigzag, zigzag, zigzag. It does not move in a straight way. So those retracement, where these levels where price waves in, waves out, is what we're going to use our Fibonacci to detect. Yeah, those are the areas we use our Fibonacci to at what particular segment the price will wave in and wave out. Yeah, like this place, price moves here upward, it moves down, upward, moves down, retraces up, moves here, retraces up, moves here, you know. So until now we finally have the reversal here. You know, there's a difference between price reversal and the price retracement. The reversal is different from price retracement. Please take note of that. Take note of that. This is a reversal. This is a short reversal. Why this? All these are retracement, the wave. So until when you have a trend being broken here, and this level could not break below this place, so then we have a reversal. But please, not all reversal are potential reversal. Take note of that. We go. That's another topic. Yeah, that's another topic. We just want to differentiate between reversal and retracement so that you don't mix, understand them. So that is the level of Fibonacci in the falling market. You see here, market price will reach, before for touch, it will initially touch the 50 the equilibrium level. Then if you could not retrace downward, it goes to 62, which is the critical price zones. Now it could not, if it could not return zone, then you are targeting, you are aiming price to get through the high probability zone 1, zone 2, which is 89 and 78, right? 71 and 78, 89 and 78. Yeah, so I bet you these levels are, it's not, price goes to this level most often times, but 62 is most constant. 52 is most constant, and 62 is most constant. Yeah, but if price could go to this place and retrace down, that means it's going to breach your break-even point downward so much. Yeah. Yeah. So that is the, then we have the opposite side of it, which is a rising market. This is a rising market. This is impulse, movement upward. A movement upward, price moves upward. You know, then contracts. It contracts against the impulse to a specific Fibonacci level, 50, 62, 89, 7800. Now we have this expansion. That is that. Now, the default setting, when you open up your, I will show you how do you edit. How do you edit your MetaTrader or any Fibonacci to get a Fibonacci platform to get these constant levels. They are there. You just have to fix it yourself, fix them in yourself. So they are there. So we do the distance. So you see the setting as this. See the setting. This is come here. You see this place. Draw Fibonacci retracement. If you cannot go there, if you cannot get it there, come here. You see it as this objects Fibonacci. Just put it. So it's here. This is a shortcut to it. This is a shortcut. Get here. For example, if you go to take the Fibonacci level of this place now, You see, this is the default. It comes in default. You change the, let's change the color. You right click, see that three dots, right click on top of the dot. It gives you the property of Fibonacci. Click on properties, you come here, you go to levels, change the levels to black, change the color to black. Then you see the levels here. You see the levels. You see this, all these numbers, right? All these numbers. The levels 236, description level 310 0.382, description. You see those levels. You change them, shift them forward. So we're going to delete this. We don't need this. We don't need this. Or let me say, okay. Let me put it this way. Okay, we'll delete those ones. So description, under your description here, you put in equilibrium level. Then under this place, you put in your critical price zone. You delete them. So you go to shift this one forward because we are going to put our this in here. You put on a 0.778. Yeah, that's your high probability zone 1. Now 0.89. Please take note of what I'm doing. Zone 2. So now you put in the 1. This is 100. Okay, yeah. You can see that we've done. You can see that we have edited the editing. So you click OK. Click OK. Can you see that? Can you see that? See it? So it has given us. So that means here the price retrace upward. So the price move upward. This is the impulse. The impulse here. This is the impulse. Price move upward. Then it moves against it. Can you see it? To our high probability 2 is 1. Okay, that is supposed to be 2. I'm doing a mistake. You can edit it. Yeah. Can you see that? So this is 62. 62, this is 53. Can you see this is the half of this movement? Half of this place is 50%. That is 2. So we have shown to you